The latest announcement from the Federal Reserve regarding the interest rate hike was made on May 3rd, marking the 10th increase since March 2020. This decision raised the federal funds rate by 25 basis points, bringing it to a range of 5 to 5.25%. While some policymakers discussed the possibility of a pause in rate hikes, Fed Chairman Jerome Powell did not implement one during the meeting. However, the hike was considered relatively modest, and the Fed plans to address issues such as bank failures, high inflation, and the debt ceiling through gradual meeting decisions. Even though Powell did not explicitly mention a specific time for a pause in rate hikes, the future path of rate hikes remains uncertain. Despite this, the Fed's stance is relatively moderate, given that the U.S. Consumer Price Index is running at 5%, which is still below the Fed's 2% inflation target. The Fed had to soften its stance because its ultra-loose monetary policy has hurt the U.S. economy over the past year. For example, the cost of servicing the U.S. national debt has increased by at least 40% due to the Fed's rate hikes. This further increases the risk of a default for the U.S. economy, which is currently in a debt ceiling impasse. The U.S. national debt has already surpassed $31.72 trillion, which is about 120% of the U.S. GDP. Each American owes approximately $95,000, and each American taxpayer owes around $248,000. This staggering amount makes the U.S. the largest debtor nation in history. The debt clock is a constant reminder that the material wealth and social welfare of the U.S. economy are based on the issuance and sale of U.S. Treasury bonds worldwide. Without debt, the U.S. economy would hardly function. Despite the debt ceiling impasse, the U.S. Treasury has already accumulated $320 billion by diverting unconventional funds from the public welfare sector to maintain federal operations. The U.S. debt problem has become the focus of global economic attention, and U.S. Treasury Secretary Janet Yellen has warned that the unconventional funds could be exhausted before June 1st if Congress does not raise or eliminate the debt limit before that deadline. If the debt ceiling issue is not resolved, the United States faces the risk of economic and financial disaster, including a default on its debt, which could cause massive losses. A default on U.S. debt would have a huge impact on U.S. financial markets, triggering a massive sell-off by global investors and thereby impacting the U.S. economy and financial markets. Based on the debt ceiling stalemate in 2011, the U.S. financial market experienced its darkest week since the 2008 financial crisis. A large number of financial stampedes occurred, and even though the debt limit was later raised, Wall Street's stock market value fell by a third, causing U.S. households to lose about $12 trillion in wealth. A default on U.S. debt could also result in a significant increase in the cost of borrowing for Americans. If the actual value of U.S. Treasuries falls significantly, Treasury yields will skyrocket, and the long-term tying of interest rates on business loans, credit cards, and mortgage loans to U.S. Treasury yields will further increase debt service costs for borrowers, making borrowing even more difficult. In the event of a default, the U.S. could experience a severe economic recession, causing a spike in unemployment. According to Moody's economic forecast, the unemployment rate could rise to around 5%, resulting in the loss of nearly 1 million jobs, including in the financial sector, which will be affected by the decline in the stock market, in addition to the potential contraction of the economy by about 0.5 percentage points. There are concerns about the impact of a U.S. debt default. Moody's economist Bernard Yaris predicts that if the default continues for 6 weeks, the U.S. could lose more than 7 million jobs. The unemployment rate could rise to more than 8%, and the economy could contract by more than 4%. This recession could also cause long-term instability in the U.S. economy, with such effects potentially lasting up to 10 years. These concerns are not unfounded. A recent report by White House economists warned that if the U.S. defaults on its debt for 3 months, the U.S. stock market could lose 45% of its value and enter a new crisis, resulting in the loss of 8 million jobs. This would have serious consequences for the global economy as well, as the U.S. dollar is the world's reserve currency and the U.S. economy is closely tied to those of other countries. The threat of default by the U.S. government has caused investors in other countries to seek more reliable and secure investment opportunities. accelerating a trend away from U.S. debt as a traditionally stable investment. Over the past year, at least 26 major holders of U.S. Treasuries have significantly reduced their holdings, signaling this global trend. This trend has been further fueled by many central banks around the world. Several traditional U.S. allies, including Japan, the U.K., Germany, France, Italy, Canada, Australia, and Israel, have already sold a substantial amount of their U.S. Treasuries and will continue to do so. This could contribute to a historic collapse in U.S. Treasuries, leaving the U.S. potentially isolated if it defaults, as the friends of the U.S. withdraw their support. If the U.S. defaults, the world's largest oil producer, Saudi Arabia, may join the BRIC nations in significantly increasing its already 40% sell-off of U.S. Treasuries. In addition, Saudi Arabia may accelerate its efforts to end the petrodollar agreement it has with the U.S. in 2020, as it has already made clear that it will not accept being dictated to by the U.S. if the U.S. defaults. This would give Saudi Arabia a direct reason to tear up the petrodollar agreement. This could prompt other oil-producing countries to follow suit, as they did in the 1970s when they adopted the U.S. dollar for oil trading. The U.S. dollar could gradually be abandoned for global oil trading. Currently, China remains the second largest holder of U.S. Treasuries, but its total holdings have fallen to a historic low of $848.8 billion since the U.S. financial crisis. China has sold more than $460 billion of U.S. Treasuries over the past decade, a sell-off rate of nearly 36%. As the world's largest trading nation, China has significant influence over the U.S. dollar and global reserve currencies. Thus, China is in a position to have a major impact on the U.S. dollar's global reserve currency status. U.S. actions regarding China's trade sector will undoubtedly accelerate the decline of the U.S. dollar's reserve currency status. If the U.S. defaults on its debt, the decline in the U.S. dollar's reserve currency status will be even more dramatic. The debate over the U.S. debt ceiling is expected to end in some form of compromise between the White House and Congress. However, this dispute has exposed the Ponzi scheme nature of the U.S. debt economy, which is the world's biggest fraud. The U.S. government has accumulated trillions of dollars in debt and has continued to borrow money to finance its expenditures. This unsustainable level of debt could lead to severe economic consequences if not addressed in a timely and effective manner. The U.S. debt crisis is not a new phenomenon, but it has been exacerbated by years of overspending and a lack of political will to tackle the issue head-on. The federal government has continued to spend more than it earns, resulting in a ballooning national debt that has now exceeded $28 trillion. This level of debt is unsustainable, and if left unchecked, it could lead to a devastating financial crisis that would have far-reaching global consequences. The U.S. government's inability to manage its debt has also undermined confidence in the U.S. dollar as the world's reserve currency. The U.S. dollar has long been the primary currency used for global trade and investment, but its dominance is now being challenged by other currencies, most notably the Chinese yuan. As more countries seek alternatives to the U.S. dollar, the stability of the global financial system is at risk. In conclusion, the U.S. debt crisis is a serious threat to the global economy, and the potential consequences of a U.S. debt default are dire. The U.S. government must take decisive action to address this issue before it spirals out of control. Failure to do so could have long-lasting effects on the U.S. economy and the global financial system, ultimately affecting the livelihoods of millions of people around the world.
Thanks for watching. If you found this video helpful, please consider subscribing for more content. Take care.